Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. You know, that introduction was exactly the same as it always has been over the last few years. But if you're watching this, you're going to notice something very different. We've got a much more relaxed, casual type of atmosphere. I'm going to have my notes on my lap because I think that that's reality. In fact, reality is I've even got my sneakers on. So, again, we're going to be tackling some important questions that we're being asked all the time. If I've heard this question once, I've heard it a million times. And that is, you know, why do we have these international investments? Why bother diversifying if the United States is the best market in the year? Will our dominance ever end? Why bother with this thing called asset allocation? It is a great question. First, let's tackle the question as to why the U.S. is so dominant. Let's face it, our GDP, which is basically a fancy way of saying we have a way of creating new ideas, growing them, and growing them for scale. There's something about our soil that allows that to happen. So our GDP is 24% of the rest of the world, and yet we only have 4% of the population. That's kind of a big deal. We are also very productive, okay? So that's another very important aspect. You know, even just 10 years ago, the US stock market represented 50% of the global index. Now we're at 66%. And the question that we ask ourselves is, will there be a point where international markets just become completely irrelevant? I don't think we're quite there yet. However, it's an important thing to kind of take a step back and say, what's going on? Because it doesn't seem like a 1 or 2 year blip. For example, in 2024, the S&P 500 did 24%. When you look at international markets, the international indices did 0.6, didn't even do 1%. That's a big difference. Was it a 1-year phenomenon? No, same kind of difference in 2023. Even more importantly, this is pervasive and it has been pretty consistent over the last 5 and 10 years. Case in point, S&P 83% over the last 5 years, 184% over 10 years. The international indice 5-year return, you ready for this one? Minus 2.1% versus plus. Okay. Oh, I'm sorry. I read the wrong line. That was the emerging markets. So much for China and all of those other countries taking over the U.S. 5 years, minus 2.1% per year. Over 10 years, we look at those same numbers, and this is, total return, 184 versus the international, 25% total for all 5 years, or all 10 years, sorry, and 11% in the emerging markets. So that has been a pervasive, dominant theme for 10 years. We keep on saying, eventually the international markets are going to go back to what they did in the 80s and they're going to outperform the US, and we'll be really glad. It's always better to be early than late. Well, okay, let's be real about this, because you know me. I like to be real. First of all, why is it happening? So it's really interesting when you get in a group of real experts, especially those who manage international or are from overseas. They'll say, well, you've got a big advantage. You've got the reserve currency of the world. Sure, but then we have to ask ourselves, why is the dollar the reserve currency of the world? Is it because it is the most dependable currency? Is it because we've just found a way of managing this economy so that inflation, yes, it went nuts, but it didn't stay nuts. It's on its way back down to the 2% target. Is it because if you have a choice of buying a bond, which basically represents debt, from France or England, right, or the United States, who do you think is going to pay you back? The United States is going to pay you back because we keep our promises, because we pay back the debt. So that is one reason We've talked about, the US and just the soil that seems to be created by our version of capitalism. We just have this way of creating the soil so that really good ideas can be born, can be grown, and then managed for scale. I mean, let's think about it. Think about in every different sector, there isn't just one big company. There's 10 to choose from. That's not the case with other international markets. You might have one company overall that might be dominant. That's it. So they don't have the diversity that we have, diversity of sector. By the way, if we go back to the 10-year return, not only did the S&P 500 outperform, every single sector in the United States outperformed a broad market index overseas. That's a big deal. So it isn't just technology, guys. It's every sector. If I can get my cheat sheets here, I'll tell you what they were. Okay, let's look at it. So, alrighty, 10-year return for the international markets was 25%. Industrials in the US, which are kind of like the smokestack companies, don't really do much, it did 77%. You look at, consumer staples, 29% versus the 25. Financials, the banking system, the financial sector, 77. Every single sector we have outperformed over 5 and 10 years than the broader indice. So it isn't just technology, even though many people would say, myself included, that technology in the United States is really good, really outstanding, and allows us to be more productive. The other thing that I would say when you look at the wealth effect, our capital markets, the stock markets, are known for the liquidity, it's deep, and it's reliable. When you want to sell a stock, you can sell it in nanoseconds. Not so reliable in other nations. So that's a big deal. Again, it's confidence. The other thing is, let's take a look at our markets. The capital market strength is the most liquid, transparent, and reliable system in the world. When you want to sell a stock or a bond, it happens so quickly and you get your money. That is not the case in other nations. That builds confidence, and people want to do business with people that they can have confidence in. Because at the end of the day, that's what it's all about. It's confidence, and it's doing business with other people. Why is the United States the reserve currency of the world? Well, first of all, we buy a lot of stuff, right? We have a very robust consumer-based economy. We buy a ton of stuff from industries overseas. But in order for those industries to do business with us, they have to do business in dollars. So what do? They buy our dollars. How do they do it? They buy our bonds. So yes, our debt in the United States is very high, but they keep on buying it because they want to do business with us because we're buying their stuff. They want to help their own economies. They want to do business with the United States. So those are some reasons. Now, back to the capital markets. Many of you know that regulations can be a real hindrance to companies, right? That's what Trump wants to do. He wants to remove a lot of the regulatory burdens. I will tell you, personal story, we went through an audit ourselves with the SEC, and it was painful. But you know what was really interesting? And I think it was interesting to the auditors because they said to me when it was all said and done, 9 months later, they said, "Thank you so much for your cooperation." And my response to them was, well, thank you. Because what you're doing, I understand the reason why you had to do what you had to do and dig as deep as you dug. You're there to protect the investing public, and I get that. So we open our books, we show you our methodology, and you're going to give us your opinion, and we have to follow the rules. Again, it's all about transparency. It's all about trust. And regulations, we may not like them, but it does tend to build trust in our systems. The last item that actually Brad, our chief investment officer, brought up is our educational system. Now, he can say this because he has a fourth grader. And what he said to me yesterday was, our Our primary school system isn't that great. Fourth graders are kind of dumb. But look at our secondary educational system. Kids stay here in the United States to go to college. Students from overseas want to come to college here because our educational system on the university level is really good. And by the way, those students who come from overseas want to stay here. So we tend to attract the best and the brightest. So those are some reasons why the United States seems to be the place to be. Now, everything isn't perfect, especially here, right? We talked about our debt. The debt in the United States is very high relative to the amount of goods and services we produce. That can be scary. That's like, somebody with credit card debt. And we are spending more than we're earning, just like we do as consumers. When we spend more than we earn, or when people do, people tend to drive up their own debt. They have credit card debt. Well, the United States has been doing the same thing by issuing these bonds. People want our bonds. So, okay, fine. We're the reserve currency. We'll keep on issuing the debt because the amount of revenue coming in is less than what the government is spending. So something's got to give, right? They either got to increase revenue, which current policy, current, administration, new administration, I should say, doesn't want to do. They want to cut taxes. They want to extend the tax law that was passed in 2017. All right, I'm turning my watch off. All right. So you get it real from me. So basically, it doesn't look like revenue is going to be increasing. And is spending going to be reduced? Well, Trump talks about cutting spending. We've got this new thing called DOGE. But right now, they have the slimmest majority in Congress than we've had since 1931. So it's going to be tough to get a lot of new stuff passed. Doesn't look like a lot of spending is going to be cut. That's really difficult to do. So chances are the debt's going to keep on increasing. When should we worry? We should worry when the same people that are buying our bonds say, you know what? 5% isn't enough. You guys have a lot of debt and we're beginning to worry that you're not going to be able to pay us back. So you need to pay us higher interest to compensate for the fact that, we're worried you may not pay us back. So that's when we have to begin to worry. Not happening yet, probably not soon, hopefully never. And I will tell all of you as a takeaway from all of this, the reason to diversify beyond U.S. borders is that could turn on a dime. And I don't want you or any of our clients to be caught with all or most of their money only in the U.S. and then they watch 30, 40, 60% of the value of that particular account go down because you know what? The United States is spending too much money. They've got, uncertain political leaders, a lot of instability there. People are getting laid off left and right. We're going through a recession. You know what? I like overseas better because guess what? We can buy low over there. And they do. That's the thing to be worried about. That's why diversification is still so important. So do I think that the U.S. is going to hell in a handbasket? No. You still want to be overweighted, love United States, and it can still continue because that soil remains. But don't ignore other parts of the world. Don't ignore other parts of the market. It's not just technology. It's not just growth. Those smokestack companies that just pay those dividends, boy, that really comes in handy when things aren't going so hot. So, again, using that old garden metaphor that I've used every single time, you want something blooming all the time. Let the mathematics work for you. You want to stack on top of stacking and build wealth over time. I believe you do that through broad diversification in the U.S. and abroad. Thank you so much for tuning in. I'm Patti Brennan. I hope you have a fantastic day. Take care.
The following presentation is sponsored by Key Financial Incorporated. The Patti Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patti Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patti Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRA SIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The Barron's Hall of Fame acknowledges advisors who have appeared in Barron's annual Top 100 Advisor rankings for 10-plus years. The Hall of Fame honors advisors who exemplify long-term success and commitment to their clients. Rankings and recognition from Barron's are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results. And such rankings should not be construed as an endorsement of the advisor. The Forbes ranking of America's top wealth advisors is based on an algorithm of qualitative and quantitative data, rating thousands of wealth advisors with a minimum of 7 years of experience and weighing factors like revenue, trends, assets under management, compliance, records, industry experience, and best practices learned through telephone and in-person interviews. There is no fee in exchange for rankings. Forbes Best In-State Wealth Advisors 2023 list, February 2023. The rankings for this list by Shook Research is based on due diligence meetings to evaluate each advisor qualitatively. A major component of a ranking algorithm that includes client retention, industry experience, review of compliance records, firm nominations, and qualitative criteria, including assets under management, and revenue generated for their firms. Forbes is a trademark of Forbes Media LLC. All rights reserved. Rankings and recognition from Forbes Shook Research are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results. And such rankings should not be construed as an endorsement of the advisor. The Ernst & Young Entrepreneur of the Year Award recognizes the endeavors of exceptional men and women who create the products and services that keep our worldwide economy moving forward. Third-party rankings and recognition are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation. Thanks so much for listening. See you next time.